This is Richard Flax at Moneyfarm with our regular monthly update. September was another broadly positive month for markets. Global bonds eked out a small gain, while global equities rose close to 4%. Broad commodities also performed well, up over 3%, thanks to a strong rally in gold. Within equities, emerging markets outperformed as investor sentiment towards China improved. Looking behind the headlines, we can see some interesting themes. First, on interest rates, we saw the US Federal Reserve cut its policy rate by 25 basis points. This was very much in line with expectations, and investors are expecting another cut in October. But the macro picture remains a bit mixed. The labour market continues to slow in terms of the number of new jobs being created, but unemployment remains pretty low. Estimates for GDP growth for the second quarter were revised upwards again, suggesting that the economy is perhaps in better shape than we thought. And finally, inflation remains above the central bank's target and looks to be drifting slightly higher. That combination might prompt the Federal Reserve to cut rates again in October, but after that, the case for further rate cuts doesn't look particularly strong, barring a significant shift in the macro picture. In the UK, the Bank of England left its policy rate unchanged. Policymakers are trying to balance relatively pedestrian growth, a weakening labour market, and fairly high inflation. The hope is that inflation will decline in the coming month, and that will allow the bank to cut rates. But if annual inflation stays close to 4%, then lowering interest rates will be a challenge. September saw a strong performance from emerging market equities, driven particularly by China. Chinese equities have staged a strong recovery over the past couple of months, helped by signs that the authorities have taken a more pro-business stance, notably in the tech sector. The government also seems keen to encourage businesses to generate sustainable returns rather than just build as much capacity as possible. That could mean we'll see better profitability from Chinese businesses going forward, and that could prove positive for Chinese equities. In terms of data that caught our attention, one data point was the growth in final sales to domestic purchases in the US for the second quarter. It's part of the GDP release and captures domestic demand. The latest figure showed a healthy 2.9% growth. The initial estimate was only 1.2. It's a reminder of two things. First, it's clear measuring economies is pretty tough these days, and the initial estimates can get revised a lot. Second, it highlights that demand in the US is still in pretty good shape, and that should be positive for the global economy overall. Politics in the US remains pretty complicated, and it looks like parties in Congress haven't come to an agreement on a funding bill, and that the government has been shut down. This isn't the first time this has happened, and financial investors have generally taken this sort of news in their stride. If the shutdown is short-lived, then we shouldn't see much of an impact on the economy. But if the shutdown lasts longer than a couple of weeks, then the impact on growth could become more significant. At this point, it's tough to see how long it will take to resolve. But even if we think both sides could benefit from a quick resolution, the political situation might lead this shutdown to be longer than it's been in the past. Importantly for investors, a government shutdown might also mean that key macro data doesn't get released, like the upcoming non-farm payrolls. That will complicate life, at least in the short term, not just for investors, but for US central bankers as well, as we all try to make sense of where the US economy is going. Thank you for watching, and look forward to speaking to you again soon.